Will Bitcoin stop at $100,000, or is it about to launch into a level no one thought possible? Right now, some of the strongest voices in global macro are warning that the market is completely misreading what is happening beneath the surface. Raul Pal just revealed a new forecast that goes far beyond hopium. He claims the entire crypto market is being driven by one dominant force that explains almost everything about Bitcoin's price movements from past bull markets to the explosive waves still ahead. And if that force flips back on, the move that follows could be far more violent than anyone expects. According to Raoul, 90% of Bitcoin's behavior can be reduced to a single factor. When that factor dries up, the market stalls. When it returns, Bitcoin and the rest of crypto go vertical. He believes that force is about to snap back into place, and the charts from previous years show exactly how fast the market can react when it does. Even last year, Bitcoin did nothing for months and then exploded more than 60% in a matter of weeks once liquidity returned. In this video, we are going to break down the new insights Raul Pal just revealed about liquidity, debt cycles, Bitcoin dominance, crypto rails, and the path to a $100 trillion digital asset market. And by the end, you'll see exactly why he believes the next move could be far more extreme than anything we've witnessed before.
It's a somewhat unusual environment. So the main driver of crypto prices, NASDAQ, everything is global liquidity. It's like the amount of money central banks create in the system, whether it's through the banking system itself or whether it's through other mechanisms like the QE or things like the Treasury General Account. So that is the liquidity. That explains 90% of all Bitcoin's price action, which is fascinating. The outperformance of alts versus Bitcoin is driven by the business cycle, the ISM survey. Once that goes above 50, people have more money. They start speculating, going further out the risk curve. So everything had been following the money, global M2 and global liquidity up until about July. Well, what happened in July was, firstly, the tariff thing started kind of kicking in and people were starting to get confused. But then what really happened is the Treasury began to build the Treasury General Account ahead of a government shutdown. So what that is, when they build it, they're basically not spending money out of their bank account. So it's less money going into the economy. And normally that's offset by what's called the reverse repo market that had been already drained. So there was no other liquidity to add because they were also doing quantitative tightening, i.e. taking money out of the system as well. So we had this double tightening going on.
Most investors focus on headlines, conflicts, election noise, tariff debates, and every distraction the market throws their way. Yet none of those explain why Bitcoin surges during certain periods and stalls during others. What consistently drives the entire digital asset space is global liquidity. When the financial system is flooded with money, risk assets ignite. When the system tightens, momentum slows. This is the observable pattern that repeats through every major Bitcoin cycle. Liquidity is shaped by decisions made at the highest levels of government and central banking. Interest rate changes affect it. Quantitative easing increases it. Quantitative tightening removes it. Even government cash balances like the Treasury General Account influence how much money actually circulates in the economy. When the Treasury refills that account, spending slows and liquidity contracts. Recently, that refill happened at the same time that the Federal Reserve continued quantitative tightening and the reverse repo pool finally emptied. With no buffer remaining, the system experienced a rare double tightening. That pressure explains why the market felt heavy, even though long-term fundamentals continued to strengthen. The important part is understanding what happens next. Liquidity cycles do not stay tight forever because governments must roll their debt. They need financial conditions that allow the system to function. Once the Treasury General Account stabilizes and spending returns to normal flow, liquidity expands again. When that expansion begins, Bitcoin usually reacts faster than any other major asset. Raoul highlighted this pattern, but the evidence is visible across every previous cycle, including the explosive move that started in November last year. The pieces are already lining up for another phase where liquidity improves rather than contracts. When that shift arrives, the asset that benefits first and most aggressively has always been Bitcoin.
How quickly do we see risk assets responding to more liquidity in the system? Like, is this can we be excited about December, or is this a 2026 thing?
No, generally speaking, the market will front run this. So we're still trying to decide when the government's going to reopen. My best guess is we will have full clarity by the end of next week. Now, whether they agree something soon, but the probabilities, the market will start finding traction. And then as it comes, it'll then start accelerating from it.
So you think we're going to hold 100K?
Yeah, and I think we will end the year a lot higher. Don't forget, last year, we didn't start rallying until November 7th. And then we did 64% from then. So, nobody believes we can have
This is what we needed. This is what we needed.
No. When liquidity conditions shift, markets rarely wait for confirmation. Investors at the top of the risk curve tend to position themselves ahead of the actual policy change, which is why Bitcoin often rallies before the broader economy shows improvement. That behavior is not speculation. It is how capital naturally reacts to upcoming injections of liquidity. The important detail right now is that the system is approaching a point where clarity returns. Government shutdown risk is fading, and once spending resumes at full strength, liquidity pressure begins to ease. Markets move early because they know what comes next. A strong example comes from last year. Bitcoin was sluggish for months, and many believed the cycle had stalled. Then November arrived and Bitcoin jumped more than 60% into the end of the year. Nothing magical happened. Liquidity turned. The same mechanism is setting up today. Raul mentioned that once the government finalizes its reopening plan and resumes normal spending, markets will not wait. Risk assets will search for traction immediately. History supports this pattern since Bitcoin has responded to every liquidity reversal with sharp upside movements. A key psychological barrier is the 100,000 level. Many investors assume it will be difficult to hold, yet liquidity-driven markets often ignore round numbers and focus instead on momentum. If buying pressure returns as spending restarts, holding above 100,000 becomes reasonable. Even ending the year far higher becomes possible. Last year proved that late-year rallies can still produce enormous gains. There is nothing structural preventing a similar surge once liquidity improves. Next up, let's uncover the deeper macro framework that explains why this cycle behaves the way it does and why the upside may still be underestimated. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in.
Expanding crazily.
Once you see that there's only one dominant factor, it actually is easier. Because then you can strip out all of the noise, all the stuff people tell you about, it's tariffs, it's this, it's geopolitics. It's none of it. It's all one factor, 90% of it.
Where does your conviction in that? Because I think there is others who would say that statement is incorrect, right? That you're missing a lot from it.
Yeah. So we produced a body of work over the last 3 or 4 years called the Everything Code, where we discovered that basically the entire system was about the rolling of debts. And so this body of work is, I don't know, if I were to lay it out, it's probably 300 or 400 pages and maybe 1,000 charts that we have in a database to show all of this. It's actually all come from demographics. It's a really big picture, and it zooms down to, you can get it down to, the next few months. And so we've definitely done more work at Global Macro Investor in this kind of nexus of macro and crypto than anybody else in the world. And it has played out really well over time. And I think it will continue to play out. Obviously, nothing is perfect. There's always wiggles. There's always things that change, like the shutdown is now the longest shutdown ever. You don't expect that. But when it comes, you kind of know what it's about and why it's stalling things. And again, to go back to the hopium zone, which is the most important part for all of us on a Friday, if I look at last year, from November, Bitcoin rallied 62%, ETH 74%, Sol 74%, SUI 235%. The previous year, we had the same factor. All year, we did nothing, exploded at the end of the year. Bitcoin 37%, ETH 40%, Solana 305, SUI 128. So we're 7th of November. This is where it started last time. Who knows? But, from here, we should be significantly higher.
One reason many investors feel lost in this market is because they are trying to interpret daily headlines instead of understanding the structure that actually governs asset behavior. The truth is that Bitcoin does not respond to scattered events. It responds to a repeating rhythm that sits beneath the global economy. This rhythm is tied to liquidity, debt rollover pressure, and demographic-driven demand cycles that shape how money moves worldwide. Once you understand this framework, the noise becomes irrelevant and Bitcoin's movements become far easier to anticipate. Raul's team has spent years documenting how debt rollover cycles create predictable waves of liquidity. When governments face large clusters of maturing debt, the financial system must loosen. If liquidity does not expand, refinancing becomes impossible. This cycle repeats across countries and always produces the same outcome. Risk assets surge when debt rollover requires more liquidity, then pause once that need is filled. Bitcoin happens to be the fastest responder because it is not tied to quarterly earnings or corporate balance sheets. It reacts immediately to liquidity injections. If you look at the track record, the pattern is undeniable. Last year, Bitcoin did almost nothing for most of the year, then jumped more than 60% once liquidity returned in November. Even the prior year followed the same model. Bitcoin gained about 37% in a period when the economy still looked uncertain, yet liquidity was expanding. Ethereum, Solana, and Sui reacted even harder because they sit further out the risk curve. This cycle is behaving the same way. The temporary stall created by the government shutdown and the slow Treasury General account rebuild is not a structural decline, it is simply the quiet phase before another liquidity expansion begins. When that expansion arrives, Bitcoin's upside can accelerate with little warning. Next, listen as Raul Pal explains where capital naturally flows once liquidity strengthens.
Think about Bitcoin, maybe long tail risk assets, AI stocks, long tail stock market. Like, where are you placing your bets?
So it's actually not easy to bet on it cleanly outside of NVIDIA, and NVIDIA's dominance, like Bitcoin dominance over time, has to fall. So we need to see other players coming in. So where's the cleanest bet? Crypto's one of them. Why? Because in the interim, we have to debase currency. And also, agents will use crypto rails. So we kind of know where this is going. So that makes it a very easy bet. It's also been the fastest adoption of any technology or financialized technology the world's ever seen, because AI you can't directly invest in so easily. The other thing is, I try and think where the world will go. So we can make plenty of money up into that economic singularity, whether it's out of crypto, buying tech stocks, number will go up over time. There will be a period where, everything corrects, NASDAQ corrects 30%, but that's kind of noise within the overall trend. But what I'm thinking about is, what about the other side of this? What has value? Now, I think crypto still has value in that because of its use cases and how it evolves. Things like digital ID become more important. That uses blockchain rails. But I also think about the value of digital art. Because in a world where you're competing in financial markets with AGI, you have no chance. So what assets can you hold? Well, you want scarcity. So can it be a house? Yes, but houses have this demographic issues and other issues. We also have the movement out of cities into places. We have remote work, so we can move globally. But when I look at it, digital art is, if we're going to go from a $4 trillion asset class today in crypto to 100 trillion by, let's say, 2032, that's going to create 97 trillion of wealth. Let's halve that because I'm an idiot. So you still create $46 trillion of wealth.
When liquidity begins to expand again, the real question becomes where capital will flow first. Many investors look at artificial intelligence stocks because that is where most of the excitement sits, yet the opportunity is narrower than it appears. Outside of NVIDIA, the artificial intelligence sector is difficult to access because most of the critical players are private companies. That limits exposure and concentrates risk. Bitcoin and the broader digital asset market provide a cleaner path because anyone can buy them without waiting for private valuations to unlock. Liquidity does not need a permission layer, it follows the path of least resistance. Raul points out that currency debasement is unavoidable in any heavy debt environment. This is not a controversial position. Governments across the world rely on weaker currency to make debt loads manageable. When currency loses strength, assets that do not rely on traditional monetary policy gain value. Crypto rails become useful because they allow money to move in ways that legacy banking cannot match. This is why adoption grows even during periods of uncertainty. Technology is not a trend, it is infrastructure that keeps being integrated into payment flows, settlements, identity systems, and digital ownership. As liquidity returns, investors look for assets that combine scarcity with long-term demand. Bitcoin fits that profile. Certain digital art assets fit that profile as well because they cannot be replicated and they live on open blockchains. That scarcity becomes even more important as artificial intelligence grows. Competing against machine-driven trading is nearly impossible, so investors search for assets that do not rely on speed or algorithmic advantage. If crypto grows from a $4 trillion market to $100 trillion by 2032, the wealth creation is extraordinary. Even conservative projections point to tens of trillions flowing into this sector. A pattern plays out in every major crypto cycle. Most investors focus on price levels, corrections, temporary fear, or the latest macro story that fills social media. In doing so, they miss the larger shift taking place behind the scenes. This shift is not fueled by hype, it is fueled by structural demand that strengthens year after year. Even Raul has said that crypto is no longer a speculative corner of the market, it is becoming a core piece of the global financial system, and that change is only beginning. One of the most overlooked forces supporting the next phase of growth is the rising integration of blockchain rails across traditional finance. Banks, corporations, and governments are experimenting with tokenization for treasury bills, payment settlement, identity management, and record keeping. The Boston Consulting Group reported that real-world asset tokenization could exceed $16 trillion in value before the decade ends. This movement brings massive liquidity into crypto without relying solely on retail interest. It introduces long-term, low-churn participants who treat these assets as infrastructure rather than speculative bets. Another important factor is the expansion of global retail access. Countries in Latin America, Southeast Asia, and Africa are adopting digital assets because they offer greater speed and stability than local banking systems. When inflation rises or currencies weaken, citizens naturally gravitate to assets with more predictable supply schedules. Bitcoin becomes an international settlement tool, Ethereum becomes the backbone for applications. Solana and other chains attract users because they offer near-instant settlement for minimal cost. Each region adds another layer of demand that does not disappear during short-term corrections. What investors often forget is that new liquidity does not need to come from familiar sources. A global network of emerging adopters can ignite the next major rally on its own. When that connects with the upcoming macro tailwinds, the result can be far stronger than what many currently expect. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.